All right, so with that, let's dive into it. This is Valuation Explained Simply. You've already heard he's Brian Feroldi. I'm Brian Stoffel, and Brian Withers is going to be behind the scenes running everything for us.
Very strict hiring criteria. We only accept one first name. That's it. Our mission here is to demystify the stock market. That's what all three of us are trying to do. We hope this course does that in its own way.
Now, we sent out a questionnaire. We got a number of responses back. You might not have gotten a chance to, but this is where people that rate themselves on a scale of 1 to 10 in terms of their ability to do everything we hope to do during this course. Our goal is that at the end of these 3 weeks, those numbers will be as close to 10 as possible.
So the starting point here is on a scale of 1 to 10, your current valuation knowledge is an average about of a 3.5. We're going to see how much we can improve that in the next 3 weeks.
Speaking of those 3 weeks, this is what it looks like. We have a crawl, walk, run cadence to these 3 weeks. And it's also worth noting that we will have office hours this Thursday and next Thursday. Those are Ask Me Anything hours. It's 1 hour at 3 p.m. Eastern time on Thursday.
If you're watching the replay of this, we do that to offset it because we do have some people that can't make them live and want to be there for the replays. But hopefully you've all had a chance to check out the pre-work, which is the Valuation Mindset Spectrum webinar that we did. We sent that all to you. We hope you watched that before you joined us live tonight.
But today we are going to be focused on the business growth cycle, and that is listed first for a very specific reason that will make a lot of sense as we work our way through the course.
Absolutely. Just a quick reminder again, please turn on your camera. We want to see your smiling face as we go through this. Another note that we have sent you the slides for this presentation, and we encourage you to take notes on it. You can use them as you go, but you get the slides, you're going to get the transcripts, you're going to get the replays, and everything that we've done, trying to make this as consumable for you as possible.
All right. So when I was a teacher, this was something we all had to put up on our boards every day. I will be able to, and it's what your students will be able to do. We will consider this a successful class if at the end of today, you'll be able to identify which stage a company is currently in on the business growth cycle by looking at its income statement.
Absolutely. So here is the layout for the next 90 minutes or so. We're going to start off by talking about what is valuation, move on to the valuation mindset spectrum. Those are pretty quick. Then we're going to talk about the business growth cycle. We're going to go over how to figure out what stage a company is in. That is the big takeaway for today. We're going to go through lots of examples and practice. And at the end of every session, we're going to end with a small group discussion. So we're going to be broken out into 3 smaller groups. You're going to be paired with one Brian, and you can ask us questions in a more intimate setting.
All right, so let's get into it. What is valuation? The whole reason we're here. Well, we would say it is the process of determining the fair value of an asset or a company, but it's not quite as simple as just pegging a fair value on something.
We love using Shark Tank as examples. And if you've ever seen this show, you understand what valuation is. After the sharks want to make an investment in a company, there's a negotiation at the end to figure out how much they're going to buy for what price. Now, the investors want to value the company as cheaply as possible. Investors are trying to get the lowest valuation possible when they're making their investment. The company, on the other hand, that's selling the equity, they often want to command the highest valuation possible, so they give away the littlest amount of equity.
And one quick note, Brian Withers, I see a couple people have said they're having trouble accessing the slides. So I'm just making sure you see that, but I'll continue on. So how do you determine what a business is worth? Well, the academic definition of that is that a business is worth the discounted value of all future cash flows, which is tough because they're future cash flows and we don't know what they are yet.
This is the academic definition that you're going to get if you go and get your MBA. We think this is, while it's technically correct, we think that figuring out what the business is worth actually takes into account many more things than simply the future cash flows discounted today. One big thing that is taken into consideration is how much profit or lack of profit is the company currently generating. That's an important factor to consider.
Another factor to consider, What is the company expected to do in the future? If it's expected to grow by 50%, it's going to have a different valuation than a company that's expected to be flat.
Another big one, as we all learned over the past 18 months, interest rates make a huge difference to figuring out how much companies are valued. So interest rates play a huge role in valuing businesses.
And finally, there's risks. Say you invest in a biopharmaceutical company. Your risk of not getting FDA approval plays a huge role in how a company is valued.
So we think that these are better determinants of figuring out how to value a company than simply the standard definition. But with that, we're going to quickly review something that we talked about in the webinar, and that is the valuation mindset spectrum, because the way that investors think about valuation totally depends on where they are on this spectrum.
That's right. So if you look at the spectrum on one end, we say it's the left end, we've got venture capitalists like Marc Andreessen. And when they think about valuation, the only thing that they have in their mind is the future potential. Nothing that they've accomplished in real life, but what's the potential that they could capture in the future?
So that is one extreme way to think about valuation. The other extreme way would be a pure value investor such as Benjamin Graham. And people on this side of the valuation mindset spectrum, the only thing they care about is the current valuation. They will buy any asset so long as they can get it cheap enough. That's another way of thinking about valuation.
But this is not an either or prospect. There's a lot of middle ground, and we gave it the name a GARP investor, a growth at a reasonable price investor. But there, even within this, there are many different shades of how one can approach valuation.
Now, what's so interesting about the valuation mindset spectrum is that you can name a famous investor pretty much anywhere along this spectrum. And all of these investors have a track record behind them of creating value for their shareholders. So on one side, you have people like Marc Andreessen, David Gardner, or Cathie Wood, who de-emphasize valuation and really care about the future potential. On the other side, you have people like Michael Burry, Ben Graham, and Warren Buffett, who put valuation first.
That's right. Now, we think that the next obvious question is, well, where do I sit on this valuation spectrum? And we've broken it down into four major variables that play a role in this. The first one is your time horizon. When are you going to need this money that you're investing?
The second factor that we think determines where you are on the spectrum is your comfort with volatility. If you're going to be investing like a venture capitalist, you better be willing to strap on to an extremely volatile ride. If you want less volatility, then you're going to be likely gravitate towards the value end of the spectrum.
Whether or not you're a bargain hunter matters. A lot of people, myself included, like gamifying the art of stock picking. And if you do, then that's going to affect whether or not you're willing to go after certain types of stocks.
And then fourth, which of these two things matters more to you? Does capturing buying the next Netflix matter? Is all that matters to you? Or is not losing money the thing that really matters to you? These four categories, your time horizon, your volatility comfort, your bargain hunting, and whether you want the upside or downside, we think really plays a massive role on where you are in this spectrum.
All right. So in general, let's say you like to focus more on the upside potential, then you're going to lean more toward that venture capitalist. If you're more focused on limiting to the downside, that's more of a value investing framework.
Time horizon. Venture capitalists are famous for having 10+ year time horizons as a minimum when they make investments into any venture business. On the flip side, if your time horizon is shorter, valuation is going to play a massive role in whether or not you make money.
Let's say you don't mind volatility whatsoever, then being more of a venture capital investor makes sense. Whereas if you like the slow and steady wins the race, that valuation mindset is going to be more appealing to you.
And then finally, your own natural instincts as a bargain hunter. When I first started investing, I was a natural bargain hunter. I wanted to buy cheap stocks. I wanted to buy high dividend yields. I was naturally attracted towards value investing. Over time, I've gradually given that up, and I've gone more towards a growth mindset.
So this is all largely a review of that webinar we talked about. And while we have the two diametrically opposed ends of the spectrum here, it is important to note that almost everyone exists somewhere in between.
All right. With that out of the way, let's get to the meat of what we're going to talk about tonight, what you are here for, the business growth cycle. Get used to seeing this chart, and we're going to have this chart basically seared into your brains by the end of this course. This is an incredibly important chart to learn and understand because it affects everything about valuation.
That's right. Now, in general, we think that most companies go through this business growth cycle. They can go forward and backwards, but in general, this is what it looks like. It also helps explain that valuation mindset spectrum we talked about, because your investors like Mark Andreessen's, Kathy Wood, David Gardner, they just happen to be investors who like investing in this stage 1 and 2, when companies are just getting started and often aren't even turning a profit.
Then there's also famous investors like Peter Lynch, Chuck Akre, Terry Smith, Manish Prabhai. They tend to invest in companies that are in stage 4 or in stage 5 of the business growth cycle. And this is where these investors like to put their capital.
And you've got your Buffett Munger, you've got your Benjamin Graham, who like in late stage 5, maybe even early stage 6 is where they like to invest their money. And it's important to note, they are all successful investors, even though they take these different approaches.
So let's break down each of those 6 phases in more detail so we can learn about what company attributes have in each phase. And we're going to start with the startup phase. In this phase, the company is really going after one thing: sales. They want revenue more than anything else. They're really trying to develop a product, bring it to market, and establish product market fit. That's why these companies are so risky. They often have little or no sales at all, and they don't even know if their business model is proven out. What they're doing in this stage is building out the infrastructure to lay the groundwork for commercialization. So it's very often that they're spending lots of money as they're hiring and they're building to do so. Now, a good example of a company that's publicly traded today, that's relatively well known, that's in stage 1, is a company called QuantumScape, which is looking to develop a next generation lithium ion battery. And we'll show you in detail how we know this company is very clearly in stage 1.
All right, that was stage 1. What about stage 2, which is the hyper growth stage? Well, the primary goal here is not so much sales, it's growing gross profit. And we'll get to what that means if you don't know yet. So ideally, the sales are growing very fast in this stage, and the gross margin is expanding rapidly. But it's also worth noting that during this phase, because there's so much investment in infrastructure happening, you hit peak losses on a profit basis during stage 2. So even though revenue is growing very fast, you're losing more money probably than at any point in your business growth cycle right here. And an example of a company like this, maybe they've moved out of it now, but a few years ago would have been Transmedics, a company that has a device that allows organs to stay alive while being transported to the hospital from a donor to a donee, and it's seen its growth take off.
Now, if a company successfully makes it out of stage 2, it starts to enter stage 3, which is something called the self-funding phase. In this stage, the company shifts its goal away from hypergrowth, and its primary focus becomes break even and start to generate a profit. It's a small profit, but it is a profit. Now, companies in this stage still tend to be growing sales at a breakneck pace. They have reached their profits are minuscule. Maybe they're break even, and maybe they're starting to generate a small profit. An example of a company that's in this stage today is a medical device company called Insulet Corporation, which serves the diabetes market.
All right, so you've reached the stage where you are self-funding. You're no longer bleeding out any money. Well, what's the goal now? The goal is to maximize your profitability and maximize margins. So what are some characteristics? your revenue growth is going to start to moderate. Not because it has to, but because you've gone after all the growth that is the low-hanging fruit. And so your growth rates on the top line will be slower, but profits on the bottom line will grow faster because you are expanding your profit margins. No company over the last 5 years has been a more clear example of this than Tesla.
After a company starts to focus on maximizing its margins and generating meaningful profits, then it can enter the capital return phase. And the primary goal here is to reward its patient long-term shareholders. Now, in this phase, sales continue to grow, but they're growing at a much slower pace than they have been historically. The company is typically generating lots of free cash flow. It's buying back stock. Perhaps it's paying a dividend, and it's really focus on generating profits consistently and giving them to shareholders. One example, there are many companies that are in this stage, would be a big giant company such as Home Depot.
Finally, you got your stage 6 companies. Now, the main goal that they have when they're declining is to create a turnaround. They need to have their business turn around. What are some characteristics of this? Well, you will likely see sales and profits falling, sometimes precipitously, and the balance sheet will get distressed, which means that it's losing cash and perhaps taking on more debt. An example of this that all of us have learned and read about over the last year is Bed Bath & Beyond, a company that has, I believe, officially declared for bankruptcy.
Yeah, I think they're still publicly traded, but it has not been a good couple of years for Bed Bath & Beyond shareholders, except for that brief period when Reddit was trying to save them. So here is that business growth cycle and the 6 stages that a company goes through, and the primary focus that a company has in each stage. We're going to explain in a little bit why we're harping so much on this, but let's briefly pause. Does anybody have any questions about anything that we've discussed so far?
You can go ahead and type those into the chat. And Brian, I'll just start off with saying the one that we normally get a lot after teaching this is, can companies go back and forth? Is it just one way? And the answer is they can absolutely go from stage 5 to stage 3. Amazon, great example. They went from extremely profitable, rewarding shareholders with buybacks, right back to when they started spending a whole bunch over the last year towards stage 3, where they were actually losing money.
Oz brought up GE possibly in stage 6, going through that decline phase, desperately trying to get back to the capital return phase. We'll see if they can do it. Okay, we just threw a little bit at you. We are going to pause and have our first trivia question of the night. What we do here is I'm going to throw a trivia question on the screen. The first person to successfully answer it in the chat is going to win an Amazon gift card. I do see a couple questions though. Linton says, why would anybody be in stage 6? Every business is going to be in stage 6 eventually. No business wants to be there, but think of the titans of 30 years ago. Sears, Polaroid, Kodak, Blockbuster, right? Big American company and brands. They failed to keep up with the changing times, and their consumers eventually shifted away from them. It's a part of a healthy business cycle. No company wants to be in stage 6, but it's a almost guaranteed that they'll get there eventually.
Yeah, Hardik says, what is fast versus slow sales growth? That's a great question. And I would say that it kind of depends on the company, but in general, I would say fast sales growth, it usually you'll see a company take off with 50% plus, then it'll start to moderate to 20, and then you see it start to flatten out over time. I mean, Apple's a great example of that. Amazon's a great example of that. So you kind of have to have the context of their recent history to know where it would fall there.
Yeah, Jaya asks, are all these companies pre-IPOs or publicly listed ones? There's a mix of both. You can be publicly traded and be in stage 1. You can be privately held and be in stage 6. Now, the companies that we're going to talk about in this course are publicly traded so that we can look at their financial statements. But whether you're private, pre-IPO or post-IPO, doesn't really matter. You're somewhere in those 6 stages.
Peter says, are stage 6 investments solely looking for turnaround, or are there other theses? I mean, sometimes there's a spin out thesis, Peter, that gets involved in that. Like GE spun out GE Medical, so that could be part of the thesis. But in general, if you're bleeding out cash, you either want a turnaround or a buyout. I guess that would be the other one, is just to be bought out.
And Ernesto asks, how do you value companies whose different segments are in different stages? We will talk about that throughout the course. That is what we're going to be talking about basically here.
One other one, Ignacio says, in general, how many years are the companies in each stage? The best companies can stay in stage 4 for years and move into stage 5 and stay there for years.
Decades.
What's that?
Coca-Cola has been in the capital return phase for what, 80, 90 years now?
Yeah.
Right.
Exactly.
I know I used to cover the biotech industry. There are some biotech companies that stay in stage 1 for 20 years. And they're just raising capital the entire way. But thank you for those questions. We'll go back and answer them, but we're going to keep on moving. And again, we have our first trivia question. So I'm going to put the trivia question on there. If you think you know the answer, we're going to do it by the first person to get it right in the chat. And tonight's first trivia question is, what animal can be seen on the Porsche logo?
Oh, William got that very quickly.
Wow. Okay. I guess we have to make the trivia questions a little bit harder. That was a little bit of a gimme. Yes, William, you are correct. And many of you are correct. The answer is a horse. We would have also accepted pony or stallion, but that is correct. These are the type of trivia questions we're going to be asking throughout this course.
All right. So let's move on to the next, which is, how do you decide what stage a company is in? And we actually think that it all comes down to looking at a company's income statement.
And specifically, when you're looking at an income statement, you're going to measure it over time. And we think that looking at these 5 numbers in particular are all you need to know to figure out whether a company is in stage 1, 2, 3, 4, 5, or 6. Now, before we get into those, we're going to quickly review all of the numbers on here, just so we're all on the same page about the income statement.
All right. So at the top of the income statement is revenue. That's all the sales that a company has made. And that does not include the discounts aren't included. It's just whatever money changed hands as a result of a sale.
Now, right below revenue on the income statement is cost of goods sold. These are the costs to make or deliver the product or service. This could be the raw materials, the suppliers, the employee costs in the manufacturing, etc. Any cost that goes directly into making the product or service is included there.
And what you get after that is gross profit. Now, if you took our financial statements class, you know that we use my coffee stand as an example. Gross profit is whatever we sold in terms of the coffee minus what we paid for the beans and the cups and the creamers and the things like that. And that is the gross profit. But that's not all the expenses that you have.
Yeah, I wish they were. After we have our gross profit, we have to subtract all of our overhead expenses. And this could be things like sales, marketing, could be research and development. It could be general corporate purposes, CEO bonuses, rent, electricity. This is where almost the vast majority of the company's expenses are located. These are called operating expenses.
And once you subtract that out, you get a very important number, which is the company's operating income. Again, that's just gross profit, and you subtract the operating expenses.
After operating expenses, we have to subtract non-operating expenses. These would be costs that don't relate to running the business. The big ones here are interest expense, if a company has any debt, or gain or losses on sales of any investments. So if a company sells a plant, a factory, and they do so at a loss, it would be recorded here.
After you do that, you get your pre-tax income, which is exactly as it sounds like, the income you have before you've paid your taxes.
Up next, we pay our federal, state, and local tax. That's called the income tax.
And then after all that, you have the bottom line, or the net income, aka earnings, aka profits that a company generates.
Now, once we have those profits, they have to be distributed on a per share basis. So we divide by the total number of shares that a company has outstanding.
And what you're left with is each share's claim on earnings, which is earnings per share, oftentimes abbreviated EPS.
Now, why are we harping on the income statement? Well, the reason is you could, by looking at the income statement, you can tell where a company is on the business growth cycle. Now, we have this chart for you to as a free download as part of this course. And what we did is we mapped out the 5 different categories on the income statement that you could look at. And we create a table so you can look at this and use this as a guide to figure out where a company is in the business growth cycle.
And you'll notice that those 5 rows that are on the bottom, they correspond to the 5 different parts of the income statement that we highlighted before: revenue, gross profit, operating, net income, and shares outstanding.
Now, as part of this course, we actually have a tool, a Google Sheet tool that we built for you, and you can actually use that tool to select, is revenue growing rapidly or is it growing modestly? Is gross profit growing rapidly, et cetera? And it will show you in that tool where a company is in the business growth cycle, and we're going to practice doing that a little later.
All right. So to really hammer this home and show you how this works, we're going to show you how different stage companies look. Now, for stage 1 company, our startup, we talked about how QuantumScape is a great example of a company that is starting selling a product. That's the goal. So revenue hopefully has turned positive. It's certainly not optimized, but everything else on the income statement is probably going to look pretty ugly. Let's take a look and show you what that looks like with QuantumScape.
So here's QuantumScape's income statement for the last 3 years. And let's take a look at revenue, which is 0. QuantumScape has no revenue at all. Just based on that, you know this company is in the startup stage.
Now, they also have no gross profit to speak of. They also have operating losses that are expanding rapidly. They lost $81 million in 2020. They lost $421 million 2 years later. So
this company really good at spending money, terrible at making money so far. Beyond that, we see the net loss. That is also hugely negative. And while it was 1.6 billion, it's largely expanding. That was largely due to coming public.
And that share count is expanding rapidly. Obviously, the IPO was in there between 2020 and 2021, but even so, the number of shares outstanding is increasing at a rather quick clip.
That's right. So no revenue, share count rapidly increasing, losses expanding. That's clearly a company that's in the startup phase.
All right, let's talk about stage 2, the hyper growth. So remember, the goal here is gross profit growth, which means your revenue is hopefully optimized for growth at this point, and you want gross profit to turn positive. Beyond that, the rest of the income statement is probably going to be very gross. And so Transmedics was the example that we used for this, and this comes from a couple years ago for Transmedics.
So here's Transmedics' income statement from 2020 and 2021. And digging through those 5 numbers, we see that revenue is growing rapidly. It went up by $5 million. And also gross profit is positive and also growing rapidly.
However, if you look at operating income, it is negative and the losses are expanding. The same thing is true with net income, negative and expanding, and shares outstanding are increasing above 10% per year,
which is quite rapid. So to us, Transmedic 2020 and 2021 very clearly was in stage 2.
All right, how about a stage 3 company? Now let's remember that if you're in stage 3, the main goal is simply to become profitable, which means that you're optimized for gross profit, and now finally the rest of the income statement should be turning positive. Our example for this was Insulet.
So let's take a look at Insulet's income statements back from 2017 to 2019 so we can see this happening. So we see revenue was growing very rapidly, 464 million to 564 to 738. So strong top line growth. Right below that, the company was rapidly growing its gross profit. So both top line and gross profit were growing very quickly.
Then, if we look at operating income and net income, what we see is in 2017, the company was losing money on both of those bases. And as we move towards 2019, they flip to profitability. That is a key signal that you have a company in stage 3.
And then finally, if we take a look at the share count, it is still increasing, but it's doing so at a relatively modest pace, growing about 4 or 5% per year, which is still high in absolute terms, but much slower than it was historically.
All right, how about a stage 4 company? This is a company that is trying to maximize its margins, which is another way of saying maximize its profitability. Company in this stage, finally, you should see the whole income statement becoming optimized, which means growing as quick as it can. And an example of this was none other than Tesla.
So here's a look at Tesla's income statement from 2020 to 2022. We know that these are a little bit smaller because there's a lot of numbers on here, but we'll break them down for you. So starting at the top, we see that total revenue sales were growing extremely rapidly. 31 billion in 2020 to 81 billion in 2022. And if you look at gross profit, not only was this number positive, but it just about tripled from 6.6 billion to 20 billion.
Well, you think that tripling is impressive. Look at operating income. It goes up more than 6x from 2 billion to 13.5 billion in 2022. Same story with net income from less than $1 billion to 12.6 billion in just 2 years.
Now, Tesla's case, its share count was also increasing at a relatively modest pace. It was growing and increasing in a positive direction, but not nearly as fast as it had been historically.
Now, we want to pause for a moment and focus on these 4 numbers because they highlight something that's key to understanding investing, valuation, and also stage 4 companies, and that is the concept of margins.
Now, if you're familiar with margins, you know what this means, but if you're unfamiliar, margins is just a profit number that you take from the income statement and you express it as a percentage of sales. If that's confusing, here's what we mean. If you've ever heard the term gross margin before or gross profit margin before, all that is a company's gross profit divided by the company's revenue. There's lots of good reasons to look at margins and divide by revenue, which we're going to cover, but that's what that term means, margin.
Now, it's the same story if you hear operating margins, that's operating income divided by revenue, and net margins are the same as profit margins, where you just take that net income and divide it by the total revenue during that period.
So let's head back to Tesla's income statement, and we're going to look at these margins so you can see that they're actually expanding over time. So in 2020, Tesla generated $31 billion in sales. It generated $6 billion in gross profit. So divide 6 billion by 31 billion, and you get a 21% gross margin in 2020. Now, if we do that same calculation in 2021 and 2022, we see that gross margin was actually growing over time, which means that as the company was selling more cars to people, it was keeping more gross profit with each additional sale. A very, very good sign.
Now, you might think that those are small increases there, but look at what a big difference it makes as we work our way down. If we take income from operations, which was about 2 billion, divide that by the 32 billion in sales, and you get a 6.3% operating margin. By the next year, it expanded to 12.1%. In other words, it was keeping twice as much of every sale as operating income, and by 2022, it expanded all the way to 16.8 8% in just 2 years.
And if we do the same thing with the net margin, again, just taking that net income and dividing by sales, we see a similar story. This is a company that is not only rapidly growing its revenue, but it's growing its profits faster than it is growing its revenue. That is a telltale sign of a company that is in the operating leverage and is clearly focused on maximizing its margin potential.
Now, once you hit stage 5, your goals change a little bit. You want to reward shareholders. So while we already know that the income statement is completely optimized up and down, what we start to notice now is that the number of shares outstanding starts to go down, which means that companies are buying back their own shares. Many examples of this, but we chose to highlight Home Depot.
Let's take a look at Home Depot's financial statements for the last 3 years. Now, its sales were growing at a relatively modest pace over the last 2 years. They jumped hugely in 2020, thanks to COVID. Gross profit was positive and growing slowly. Operating income, net income, all those numbers were positive and growing slowly. However, this number here, the diluted weighted shares, common shares outstanding, this number is decreasing with each passing year. The reason that that's happening, Home Depot is buying back its own stock from the markets and retiring shares. So Home Depot, very clearly, just by looking at its income statement, is a company that is in stage 5, is in rewarding shareholder stage.
All right. Now let's finally talk about stage 6. This is one that you can get trapped in and can cause some trouble. So it's important to know what happens here is everything on this income statement starts to turn south. They want to turn it around, but the fact of the matter is that it's not looking good. One interesting thing to note is sometimes the shares outstanding go up because the company's trying to raise money. Sometimes it goes down because they think there'll be a turnaround and buying back shares now will look like a good move. Let's see which choice Bed Bath & Beyond made.
So here's Bed Bath & Beyond numbers over the last 3 fiscal years. Very clearly, revenue went from 11 billion to 7.8 billion. Gross profit went from 3.5 billion to 2.5 billion. Operating income, operating loss was actually huge, and that was not going well. They were generating consistent net losses, and they were actually buying back a lot of their stock along the way. This is actually a big mistake that many companies make when they're in stage 6. These companies should be focused on saving themselves, but oftentimes they're taking the cash that they're generating and they're buying back their stock. This is something that ultimately will lead to their demise. It looks smart in the moment, but time proves it to be a very dumb move. But the big thing for me here is if you see revenue and gross profit consistently going in the wrong direction, that's a kind that a company is in stage 6.
That's right. So you will get a tool where you can use this to figure out what stage a company is in, but this is how you figure out what stage in the growth cycle a company is in. And with that, we want to get to the questions, and I want to start out with Sushant, who asked a little bit earlier, can we elaborate on going back and forth between stage 4 and stage 5? What are the tipping point or key drivers? One tipping point or key driver could be that the company all of a sudden hits on a new business line. And when it hits on a new business line, it decides to aggressively reinvest in that new business line. That would be an example of a company going from a stage 5 or 4 to a stage 3 or 4 because they're putting a lot more money into it. An example of this could be something as simple as Amazon when it discovered the gold mine that was AWS over 15 years ago. They decided that they were going to reinvest heavily in that business, which incurred losses in the short term, but was an enormous opportunity in the long run. It was worth going back in that situation.
Evgeny asks, what's the difference between basic and diluted shares outstanding? Basic are all the shares that are currently outstanding. Diluted is all the shares that could be outstanding. The difference between those two is often stock-based compensation. So they've set aside those shares, that those shares could be issued to employees if they get vested over time. It could also represent a convertible bond offering, so they might convert into stock. That can be included. So typically, most investors, us included, when they're looking at earnings per share, use the diluted number to be more conservative.
Ernesto asks, how many quarters or years need to pass in order to deem that a company has moved up or down the spectrum? For example, Tesla's margins have compressed for a few quarters, but I don't think it's a declining business. And that's a great point. Tesla is a great example of this. They have made the conscious decision. Well, most people would say the conscious decision. Some bears would say that they were forced to shrink their gross margins in order to increase the amount of sales that it has. It is worth noting that their profit margins, I believe, I'd have to go back and check, are still expanding because they still have operating leverage that they're squeezing out of their system.
Yeah, correct. The CFO recently said the management is not focused on the gross margin. They're focused on the operating margin. That's the number they're guiding the business towards. So while their gross margin is declining, their operating margin through expense control is actually maintaining fairly healthy. This is why, that's a great example of why you need to look at multiple numbers: gross profit, operating profit, net profit, not just one, because there's sometimes, depending on what's happening with the business, one of those numbers might be temporarily impacted, and temporarily could be measured in quarters or years.
Yep. And Gary says, yes, all those 20% coupons for Bed Bath & Beyond gone to waste. We love having you back, Gary.
Okay. Well, thank you for listening to that. We are going to move on to our second trivia question of the night. Head on over to the chat, and the first person to get this one correct is going to get
Hey, Brian, before you reveal it, Gary let me know that the slides have the trivia answers in it.
Oh, no.
I would just ask if you have seen the thing. This is the honor system now. Please don't answer it.
Yep, I guess we forgot to do that.
Yes.
Yeah, okay.
We'll remember that for next time.
Assuming you haven't cheated and looked ahead, the question is, there are 4 countries that are still using the shilling as a currency. What continent are those 4 countries on?
We've only got 6 that you can guess from, basically. Here we go. Nanuj is the first one, it looks like, to get it. Yeah. Which is Africa. And which 4 countries are those, Brian Feroldi?
Can anybody name any country that uses the shilling?
Yeah, I'd be
very impressed. I'd be very impressed if anybody knows a country that's using the shilling.
Well, I got no answers here. Why don't we show them?
Okay. Those countries are Kenya, Somalia, Uganda, and Tanzania.
Yep, there we go.
Yeah. Zacharias, you know it exactly. All 4 of them.
It's amazing.
Oh, lesson learned on that one.
All right, a little bit of housekeeping to do now, because it is important to figure out, well, all right, how do I find an income statement? We don't want to assume that everybody knows how to do this. So there's 3 basic ways to do this. Now, the first way, and we would argue the best way to do it, is to use the Edgar database. If you type in to Google or your search engine, Edgar SEC database, or Edgar company search, this comes up. You just type the ticker symbol into that box there, and you'll have access to a company's financial statements.
Another way is to use an aggregator tool such as Yahoo Finance, the most popular one out there. If you click up a company and you click on financials, and then income statement, and then annual, you will get a nice clear look at the revenue, the gross profit, the operating income, etc. And you can do it that way.
And the one that we're going to use a lot is a tool that not many people know about, but we have become huge fans of this tool. It's free. There is a paid version that you can use. It's called stratosphere.io. So say you go there and you type in Apple. If you look below, you can click on income statement, and you'll see what pops up is you've got your revenue, you got your gross profit, operating income, and net income. It is worth noting that if you click on that income statement, it will not show you shares outstanding. So that is the one drawback to it. However, it is a very useful tool.
Yeah, we like stratosphere.io because it's free and you can visually graph income, you can visually graph gross profit, you can visually graph that. It's a really powerful free tool. So if you've never used it before, highly recommend checking it out.
All right, so we're going to go through 2 examples of just seeing an income statement and not knowing anything else about a company. We're going to show you where our eyes go and how we would use the tool that you're going to have access to in order to determine its growth stage.
So here is a random company's income statements for from the years 2004 through 2008. So if you were looking at this company's numbers, take a second to look it over and ask yourself, what stage of the business growth cycle is this company in? Now we're going to have several examples in a row here. We're going to do this one for you just to show you how we would do it.
All right, so the first place your eyes go is toward the revenue. And you see that revenue has gone from nothing in 2004 to $36 million a few years later. Definitely fast sales growth. It's more than doubling every year.
The next number we look at would be gross profit, recorded here as gross loss, which indicates that they are losing money on sales. So they're not making enough revenue from selling their product. It's actually costing them more to make the product than they're earning from selling it. So this number is negative.
Next, we would go to operating profit, although again, here it is technically called operating loss. And as we can see, those losses have increased every year that's included in this, from a loss of 14 million all the way up to roughly $90 million by 2008.
Same story on the bottom line. Net income here is negative, and it was 13 million, now $92 million. So net income is heading in the wrong direction.
And finally, if we look at the number of shares outstanding, we see that it went from about 290,000 to 27 million a few years later. Now, when you see that, you know that the company probably went public over this time frame. But either way, this is the powerful part of the tool we built for you, because now you can take this information, plug it in, and see really quickly where a company is in its growth cycle. So let's see what that looks like.
So here's the download tool that we have for you. You can select each of these tabs here, and those numbers will move over and show you what stage it's in. But we're just going to do it on the presentation here for simplicity. But we're going to plug these in and say that sales is growing rapidly. Gross profit is negative. Operating profit is negative. Net profit is negative, and the share count is increasing very rapidly. And if we look at where those things are trending, this company to us would be somewhere in the startup to hypergrowth phase. So somewhere between stage 1 and stage 2. So if we were given that income statement, we would very clearly say, yep, company's in startup / hypergrowth stage.
And it's important to note that this is not an either-or prospect. It's okay for your conclusions to fall somewhere in between 2 of the stages. So as we said, it'd be between stage 1 or stage 2. We'll see if there's any questions after we do the next one, because this is basically how it works. But if you're curious, this company was Insulet from 2004 to 2008.
So we're going to do one more with you, and then we're going to ask you to do it on your own. Brian Withers just shared a link to that tool in the chat. But here's another company, and here's another company's income statement over a 5-year period. So again, Brian, if we were doing this, we know nothing about this company, what would we do?
All right, we would start with the revenue, and I see that they've gone from 66 to 97 to 152. Basically, that top line of sales continues to expand quite rapidly.
Next number to look at would be gross profit. Not always reported on the income statement, but we love it when it is. In this case, gross profit here is positive, and it is growing very rapidly. In fact, gross profit is growing faster than revenue, a very good sign.
That's right. Now let's look at its operating loss. It went from 59 million and then it has continually more or less contracted from there. There's some blips. So it is still losing money on an operating income basis, but those losses are narrowing.
Same thing for the net margin, the net loss. The net loss was trending downwards, so it was narrowing, but it's still negative on an absolute number basis.
And man, if you look at those shares outstanding, they are still increasing quite rapidly, nearly doubling from 2009 to 2013.
So if we were to go over our handy tool and fill these numbers in, that revenue and sales were growing rapidly, gross profit was growing rapidly, the losses were peaking and it was kind of nearing trending downward. Same thing for the net profit, and the share count was still increasing rapidly. To us, that would mean that this company was in somewhere between stage 2 and stage 3. Doesn't exactly fit perfectly, but it would be somewhere around this number here. And you would hope that this company within the next couple of years would be moving towards self-funding, which is a direction that it is heading.
All right, so we've shown you how our eyes would look at this. Now we're going to have you do this on your own, and we're going to give you some time to do it. But before we do that, we just want to see if there's any questions about what to look for on that income statement. And maybe while we wait and see if anybody has questions, Brian, you can reveal what company that was.
This company was called Insulet.
Oh, so same company before.
Just a couple of years later in the company's development. So, okay, what we're going to do now is show you this on the screen. This time we're going to be quiet for a couple of minutes. Take a look at this income statement and tell us in the chat what stage you think this company is in.
When you have that answer, feel free to type it in the chat.
Been about 30 seconds and we've already gotten a bunch of answers, which I take as a really good sign, but we will give it a little bit more just so people have time to look.
This is very encouraging.
Yes, absolutely. It's been a minute and we've got about, what, 20 plus people have already answered?
Yep.
Linton asked, usually we just look at 3 years. Linton, the more data you get, the better. And if you use tools like Stratosphere, you can often see 5, 10 years of data visually, which makes it easy and easier. But if you often only have as much data as the company has publicly provided to you. So it's fairly common to look at 3 years, but if you can look at more, great.
Yep.
Financial we think you can draw conclusions from 3 years, from 2 or 3 years.
Financial statements usually at the maximum include 3. Sometimes they include 5.
Well, it seems like everybody here is right in the same ballpark. So Brian, let's just go for it.
Sure. So we look at that top line revenue. That's increasing rapidly from 738 to over $1 billion.
Right. Modestly going rapidly, but not.
Yeah, you're right. It is more modest.
Yep. Gross profit positive, also growing at a modest pace, not breakneck speed, but definitely at a robust pace.
Hey, operating profit is growing. And if you look, it barely grew to 2020, but then it more than doubled in 2021.
Mm-hmm. Net income, big difference between operating income And net income here, it looks like this company lost a bunch of money on interest, so it must have a ugly balance sheet, lost some money on extinguishing some debt, but still net income is positive and trending in the right direction.
You know, Brian, I'm just realizing now, if we look at that operating income, it looks like it barely grew in 2020. What could have happened in 2020 that would be
Can't imagine. I
accounting
can't
for
think of
that?
anything that happened in 2020.
And then we look at shares outstanding. They are still growing. They're up about 10% over this time frame. So they're still issuing shares either to pay their employees or to raise money.
So if we were to fill those in on our little sheet here, we would get something that looks a little bit like this. And if you kind of take roughly the midpoint of those numbers, we would put it somewhere between stage 3 or stage 4. We had a lot of people that stage said between stage 3 and 4, 3.5. So great job to everybody that did that. You really seem to that's where we would put it on there as and as well, right around there.
And I see that there aren't any questions. So maybe we can move on to the next one. Brian, what company was that we just looked at?
This is a company called Insulet Corporation. So this is the same company. We have 20 years of data on this business. And there it's very clearly gone from 1 to 2 to 3 to 4. And if you look more recently, it's very clearly into 4.
As a fun piece of trivia, why did I choose Insulet?
Because I was an employee there back in 2004. Worked there for about 10 years. Watched them come public. But yes, it's a great case study with figuring out which phase it's in. But here's another one for you. Take a look at this one. We'll be quiet for a little bit and just tell us what phase you think this company is in.
As we did last time, a lot of people congregating around 2 different answers, which is very encouraging to see. I bet some people listen to your little cheat code for finding one of them, which is a very good one.
Great. Awesome. Well, been about a minute. Just so you know, we practice this like before we do it, and we're always like, how long are we going to give people? We were like, 3 minutes, is that enough? 4 minutes, is that enough? And
turns out 30 seconds.
60 seconds is apparently the correct answer.
I will say this is a lot faster than the first time we taught the course.
It is, yes. So well done. Well done, everybody. You guys have really hit it on the head. So Brian, let's just go for it. So
that's right.
Net income at this company growing.
Net sales.
Yep, net sales. Yep, that would be the correct, I think. Net sales growing pretty robustly, 110 to 151. So a nice job there.
Same story when we look at gross profit, growing pretty robustly. It is worth saying, as you dig through a lot of these, so you guys know, COVID was something that is like making some companies hyper grow that normally wouldn't, or slow down that normally wouldn't.
But operating income here was positive and continues to grow at a pretty good clip.
And net earnings are increasing at a rather good clip.
And then to me, the giveaway here would be the diluted share count. This number is heading in reverse. That is the direction that you want this number to head. So to me, this company is in the capital return phase. But again, if we put those in and you got something that looked like this, that would hint to us that the company is in stage 4, stage 5, more closely to stage 5. And Ranjit, it does look like Home Depot, doesn't it?
But is it? But is
it? Does
it
look like Home Depot? It's not Home Depot. It does look like Home Depot, but this company is called Apple. It's called
Couple
Apple.
questions real quick. Kim says, how do you define growing modestly versus rapidly? What percentage growth are you looking for? And Kim, that's a great question. That's why I threw that caveat in about the pandemic, because a lot of companies that were at like 10% growth, and Apple would be one that was maybe not at 10% growth, but it was a company whose growth was definitely moderating quite a bit. And then because of the pandemic, it kind of re-accelerated. It was kind of like an artificial catalyst. And unsurprisingly, we've seen that growth rate come down quite a bit because it kind of pulled forward a lot of that growth. So if you're looking at the trailing 3, 4, 5 years for a while, it's going to look like something that we have not seen really at any point in time since investing's been available to the markets at large. Wars would be the other thing that can really change that.
Carl asks, what does it mean, diluted shares outstanding? So then again, that's just the total number of shares that are outstanding right now. That's called basic. And then diluted, it just means all of the shares that could be outstanding if all the options get exercised, if all the stock that's been issued to employee becomes stock, if all the convertible stock that's out there gets out there. So there technically are two different ways of counting the number of shares outstanding. For most companies, the difference is pretty minor. In some cases, it's pretty big. For example, if you follow Tesla, when Elon got that huge pay compensation package, those shares weren't issued. He had to do things to get that stock converted to him, and that caused a big difference between basic, which did not include his pay package, and diluted, which did. So that's just the difference. Diluted is the more conservative number.
And so Nina says, this is a good question. So are you saying that if diluted shares increase, that's a bad sign? I mean, I wouldn't say it's a bad sign. What you need to understand is what it means is the company is either doing one of two things. It is either issuing more shares because it needs the money. And sometimes that can be a really good decision. Like there are some companies, Shopify raised some money back when its stock was trading at like 170. That was actually a really good decision that helped the company fund some of its initiatives. It does mean you are getting diluted. Or it means that they're paying their employees with shares, which basically means you as a shareholder is paying for it. But all things being equal, from 30,000 feet, yes, you want to see shares outstanding going down.
Yeah. In a perfect world, every company you own would have a declining share count. But just because a share count is increasing doesn't necessarily mean a bad thing, especially if a company is in early stage in the startup phase. Oftentimes the only way that they can raise capital is by issuing shares, by taking on new investors. And, in the startup phase, Google share count rising like crazy, that turned out okay for shareholder. Like most publicly traded companies, their share counts are rapidly rising in the beginning. And if you pick a great company, it's not going to harm you from doing very, very well. But in an absolute perfect world, the share count would be declining.
Ernesto said, agree or disagree? More than 30% is fast, around 15% is moderate, 10 and less is slow. In general, I would agree with that. But what I would say is context is everything. So I mean, certain companies, I'll also say that if you have a company that was growing at 60% at the beginning of a year, and by the end of the year, it's growing at 10%, that is very different than a company that was growing at 15% and is now growing at 10%. So that all plays a role in this.
Ray asks, when stock-based compensation is issued, does that dilute the shares? Yes. When stock-based compensation is issued to people, that is the company creating brand new shares of stock and giving them to the employee, sometimes for zero cost. So when a company is issuing new shares of stock, that is the definition of dilution. Now, that in absolute terms isn't all that bad. The thing that I pay attention to is the rate of dilution, more so than the absolute numbers. My rule of thumb is I want dilution to be 3% or less in any given year. If it's higher than that, then the company is really diluting shareholders. Palantir, if anybody knows the company Palantir, a very popular company, they just reported earnings earlier tonight. I was looking over them. Their share count rose 10% year over year. That would be a pretty high dilution rate at the stage of the business that the company is in right now.
I'm going to let you take the one from Kapil because I feel like you'll do a better job at it. And I'm going to answer Linton's, which is how do you justify raising capital through share offerings? Think of it this way. If you have a company that's just doing a great job and you need to build out your research and development, your sales force, and to do that, you got to spend a lot of money and more money than you're bringing in. You don't want to run out of money because if you run out of money, you go bankrupt. So you have two options in order to make sure you've got enough money to hit stage 3 where you're self-funding. You can take on debt or you can issue new shares. And as a shareholder, I'm okay with fast-growing companies that are executing on their mission, issuing more shares, as long as it's reasonable, because if I own a slightly smaller percentage of a growing pie, that's fine with me. If I own the same or a larger percentage of a pie that's going to 0, I would rather own something that's above 0. And I believe that issuing shares offers that flexibility. It can be taken advantage of, though, which is why you need to keep an eye on it.
So I'll answer Kapil's question, last one. So employee options vest in staggered ways over multiple years. When companies report, is the total outstanding or the ones vesting over the next year? The answer is yes to both. So let's say an employee comes and they get a 4-year stock grant. After 1 year, 1/4 of their options have vested. Those would be included in basic shares, and the remaining 3/4 would be in diluted shares. But as soon as an employee is granted something, those could potentially be shares outstanding. Those are counted in diluted. So they become basic. They go from basic to diluted as they vest over time.
Yeah. All right. So all that being said, we've got one more example for you, and I'm very curious to see what people think of this one. So take the next couple of minutes and tell us what stage this company is in. People who are answering have not been using our cheat code.
Jaya, very confident that we're putting Bed Bath & Beyond up. Yeah, Nina, good question.
Yeah, Nina's got it. All right, well, let's take a look because people are right. It doesn't check every single box for any of them.
First off, I want to just say you are all reading the income statement in the right direction, which is not a given.
That's important. True. We didn't actually talk about that. That's pretty important.
So some companies report right to left, others report left to right. You guys were all looking right to left. That's good. So sales were 8.3 billion. Now they're 5 billion. That seems like the wrong direction to me.
Gross profit was 2.3 billion. Now it's 1.3 billion. Not great.
Operating loss was negative and it is decreasing, but it is still a pretty big loss.
Yep. And same thing with the net income. The losses are decreasing. That's a good sign, but they're still negative.
Mm-hmm. And then we see the diluted share count. Holy cow. That share count is declining extremely rapidly. So this is a company that is rapidly buying back its stock from investors. I wonder if that's going to work out well.
Well, let's plug this in and we can see where it would go. You see declining and negative, and then this stable and declining here. So what does that mean? Well, you see that operating and net profit being negative kind of can be on either side of this. But what we would argue was that it could be in stage 1 or stage 6. But here's the thing. You know what company's income statement you're looking at. And if you knew the company you're looking at is Radio Shack in 2020, you know they're not in stage 1. So that's obvious. So you can say, okay, clearly this is a stage 6 company.
Right. So the stage would be 6. Now, Brian, let's answer this question that I hope. So it's very clear that you guys now know
this is very good.
Figure out what stage is in, which is awesome. That was the goal for this evening. Why are we talking about this?
We're talking about this because the next 5 days are totally dependent upon you guys knowing this. And so what that means is each different method we have for valuing a company, whether or not it works depends on what stage it's in. So on Wednesday, we're going to talk about total addressable market. That's only really helpful in stage 1 and stage 2, maybe a little bit in 3 and 4, and not at all at 5 and 6.
In fact, I think that this here is one of the biggest valuation mistakes that a lot of people make. They get to know one valuation method and they just use it at the wrong company at the wrong time. So today was all about figuring out which stage so you know which valuation method to use depending on the company you look at. So next Monday, we're going to talk about multiple analysis. Multiples are very commonly used, but multiples are somewhat useful in stage 1. They're very useful in stages 2 through 5, but they can be a red herring. They can be a false signal if a company is in stage 6. I guarantee you, Radio Shack had a dirt cheap looking PE ratio in 2015. Yeah. And if you bought it, you lost money.
Yep. Next, we're going to talk about discounted cash flow. And we have a simplified discounted cash flow model. Now, this is a very popular way of coming up with a fair value of a company, but we'll also talk about some of the shortcomings. But one of the biggest shortcomings of a discounted cash flow model is that it's only really helpful with stage 5 companies. That's why Warren Buffett and Charlie Munger talk about it all the time, because that's where they invest. And the error that many investors, ourselves included when we are getting started, make is that we use that on stage 2 and 3 companies. It doesn't work that way.
And then the final one we're going to talk about, the final valuation method we're going to talk about, is the reverse DCF model, most useful in stages 4 and 5. Utterly useless to investor when a company is in stage 1 or stage 2. So we're going to kind of go down up the business growth cycle, and we're going to talk about the 4 valuation methods in order. And it's really, really, really important that you know which valuation method to use and when.
Now, this helps explain why all these different people on here can be successful investors, even though they look at things from starkly different angles. Because if you are a Mark Andreessen, you're just using total addressable market, and you only need 1 out of every 15 of your investments to hit, because once it does, it is a multi-bagger.
And if you are David Gardner or Kathy Wood, you're not only going to look at total addressable market analysis, you're going to introduce the multiple price to sales, or perhaps even price to gross profit. So if you are the type of investor that looks at stage 2 companies, those are how you're going to value them.
Stage 3, we didn't fit any pictures in here. That's largely because we wanted you to read the words revenue and profit. But if you're in there, the only real metrics you can use are price to sales and price to gross profit. Price to gross profit is one that almost no one looks at, but we think it's worth looking at.
If you're a stage 4 investors like Peter Lynch or Chuck Akre, you're going to look at the price to forward earnings ratio, the price to free cash flow ratio, or one of our favorite valuation methods, the reverse discounted cash flow ratio.
Now, one of the best parts about stage 5 companies is that they tend to be very, very predictable. And when it's very predictable, there are a number of methods we can use to value them. That includes, finally, the PE ratio. Note that Brian and I talk about the PE ratio not being useful all the time. And that's because this is the only time where the trailing 12-month P ratio actually is helpful, but so is free cash flow, discounted cash flow, and reverse discounted cash flow.
And finally, in stage 6, this is a very dicey place to invest, but some people do it successfully. In this phase, a lot of the multiple analysis that you can use are utterly useless, and you're really betting on largely a reverse DCF to prove you correct. But let's move on with a quick review, and then we're going to do breakout sessions.
That's right. So takeaway number 1 is this growth stage, breaking it down and what the primary focus for a company is in each stage of its growth.
We talked about the 6 stages, and we talked about how in phase 1, the startup phase, a company's primary goal is establish product market fit, very little sales, and they're hiring like crazy. So net income is the net loss is rapidly increasing.
In fact, those losses are going to peak in stage 2, the hypergrowth phase. Even though revenue is growing really fast and gross margins are expanding, the company is investing aggressively in itself, and that's why you hit peak losses.
In stage 3, a company reaches break even. It's not optimized for profits yet, but getting to stage 3, the self-funding phase, is a big deal.
Yep. Once you hit stage 4, you're focused on operating leverage, which means even though revenue growth is moderating, profits are growing faster than the revenue because you're expanding those margins.
In stage 5, the company is big, mature, stable. It tends to focus on returning capital to shareholders, primarily through dividends and buybacks.
And then in stage 6, you hit the turnaround phase where sales are falling, profits are falling. And I saw a student chat ask, well, do we give a company credit for whether or not their losses are stemming? It all comes down to the balance sheet, because if you don't have cash to survive any losses, then you are going to hit bankruptcy.
Now we're going to give you this cheat sheet, which shows you how to look at the income statement and guide yourself to figure out which stage a company is in.
And note that all 5 of our rows correspond to a different line on that income statement.
We talked about the valuation mindset spectrum and where some big famous investors fit on that spectrum.
And importantly, showed you why investors can be very successful even if they have wildly different ways of valuing a company, because they're valuing companies that are at different stages of their growth cycle.
Now, we do have some homework for you. We would encourage you to do it to really hammer in these lessons. We're going to ask you to do the homework, and once you're done, post your conclusions in the Circle community. We're going to review the homework. If anybody makes any mistakes or have any questions, we'll be able to answer them for you there.
So you have three different income statements that you're going to evaluate and tell us what stage of growth the company was in. Please note the direction that the years move in, because they're not the same for all 3 of these income statements. You will post those in Circle in our community.
With that, we're going to go to the general Q&A as a big group and answer any last questions that we have. We also have some very common ones that we've gotten from other times we've done it. So Brian, let's answer those. We already touched upon this before, but a very common question is, how long do companies stay in each stage? The answer could be months, or it could be decades. It totally depends on the business. In the perfect world, a company would blitz through stages 1 and 4 and be in stage 5 for its entire operating history and stay there for years. That's not impossible, but man, is that hard to do. Yeah.
Next, can a company move backwards? We talked a little bit about this too, but yes, absolutely, it can move backwards. I again and again think Amazon is a great example of this, because when they see an opportunity, they will invest a ton of money in it. During COVID, they did this. After COVID, they've done it. New business lines, they'll do it. So they move themselves back and forward all the time.
Raul Rina asks, Rihanna, sorry if I mispronounced your name. Is there any way we can tell that a company will not go to stage 2 or 3? In other words, what if it stays in stage 1 the entire time? Happens all the time in venture world, right? Somebody has an idea for a drug or a tech product, and they get absolutely no product market fit. They get no sales growth at all, or very modest sales growth. Lots of companies that are started stay in stage 1 and die in stage 1.
Yep. And finally, do all companies follow this pattern? The answer to that is no, they don't. This is a general way of looking at a company. There are very few companies that are publicly traded that are in stage one, to be clear. Usually that happens before they ever come public.